Good morning, everyone. Welcome to Monday morning's pre-market pulse or MPC markets morning call. We saw markets basically drift off in the equities on Friday night. Just that tariff uncertainty really shifting investors' minds to real assets. So we saw, the likes of silver hit fresh 15-year highs, running about 7 or 8% into the last 2 days of the week there. So. Which was a good result for certainly for MPC clients who've been long silver for quite some time. Now, obviously, you can see there the Euro stocks drifted off. Over the weekend, we've seen tariff announcements against the EU, which was a little bit of a surprise. Mexico, amongst others, obviously there was the ones earlier in the week last week as well. So. You've got the Dow down about 0.63, the S&P down about a third, the Russell falling about 1.2. All of them sort of down for the week, and we are coming into a week of US earnings this week. First real sort of earnings we've got. Having a look at the market map overall, NVIDIA, Microsoft really kept the market a little bit better bid. Tesla, Google, and Amazon were up slightly. That probably kept the market, will save the market from some downside trouble realistically. That services sector and the tech, like ServiceNow, Salesforce, etc., really haven't been helping the market of late, which is probably more of a reflection on the whether they think the US economy is going. And we've also seen, the banking sector had a bit of a weak night for the first time in quite some time. We've got bank earnings coming up this week, and that will obviously set the tone moving forward. The chip stock's still going okay. AMD, Texas Instruments, Micron, all fairly well bid over the course of the session. Apple down about 0.5%. United Health bounced a little, although after a deep dive on that stock, which used to be the world's biggest healthcare name, there is a lot of issues going for that company going forward. So it is one of those buy the dips with extreme caution sort of scenarios. Now, commodities have done extraordinarily well. Copper finished basically 11% up for the week. Silver around about 5 overall, but really importantly, busting through to those record highs, when I say record highs, 15-year highs, which have been obviously a very large bit of resistance for quite some time. That gold-silver ratio, interestingly, is usually around about 60-1. Currently, it's around about 80-1. So if you go back to the historical average of the gold-silver ratio, that places silver at around about $55. It got fairly close, 39.25, I believe the high was on Friday night in the futures. I would expect that trend to maybe continue a little bit higher. You've got all of those metals obviously going first. Now you've got silver, copper, platinum's started a bit trade up as well. And you've got other stores of value like Bitcoin up around about 9.6% for the week and making new record highs. And that's really a sentiment where, investors are looking way more at real assets and possibly just starting to take some money out of the stock market overall. Coal was up as well. It was gone back to nearly $100 a ton, which is super important. There's talk of a meeting in China this week around the Central Urban Work Conference in 2015. Has been drawn comparisons to. There's sort of a bit of a secret meeting of a similar kind. And in the past, that conference ushered in massive stimulus focused on government-backed housing. So there is a little bit of hope there. We've had Rio and BHP rally around about 10% in the last, probably 3 weeks. Still cheap in my opinion. Coming at the expense of Commonwealth Bank, which is, again, fair enough considering Commonwealth Bank is the most expensive bank in the world and compared to itself even is at ridiculous levels. Overall. So yeah, we will have those US earnings coming through, obviously from about Tuesday onwards. Bond yields, interestingly, went to the sort of recent highs as well on Friday night. So look, despite all of the tariff, geopolitical, monetary policy uncertainty, this US market seems hell-bent on hanging in there. But the risk, I believe, is strongly to the downside. Now, what we've got to realise about US earnings is that this is from the quarter where Liberation Day basically kicked off 2 days in, and we saw a massive drive down that hit to the downside, and then obviously we bounced back over the course of that quarter in what was the sharpest bear market rally in history in 120 odd years of stock markets. So that's why I'm thinking that we're probably on, risk is definitely to the downside, I believe, at this stage. And if you think about it from a business standpoint, I mean, apart from the banks, which may get higher trading volume because they obviously have clients trading, investing in stocks, etc., and rates staying a bit higher for longer over there, which will help their net interest margin, I think that you'll see the retailers and some of those, some of those service-based industries probably a little bit hit, because it would, if you're a business, it would have been extraordinarily hard to plan with all of this uncertainty over the last 3 months. Despite the fact that it's bounced back, Main Street doesn't move as fast as Wall Street. So this bounce back might be just a little bit premature, and it'll be interesting to see what sentiment comes through, because consumer sentiment has drifted, and obviously, I would say business sentiment will drift lower as well. Interestingly, Jamie Dimon, who's the JP Morgan CEO, always a bit of a bear, was saying that there's a very large chance that we could get 40% chance that the next move could be a rate hike. I think that's rattled investors quite a bit. But as you can see here, we've got trade balance and industrial production, GDP and retail sales for China in the first 2 days. If there is signs of life, I would imagine you'll see that materials sector buoy the Aussie market. I don't think it's going to trigger a broad rally in our index necessarily, but I think the bank earnings as well, which should be fairly positive, I would imagine. And you've got JP Morgan, Citigroup, BlackRock, the biggest biggest fund manager in the world, trillions and trillions of dollars there, and their ETFs and their ETF inflow with their Bitcoin fund will probably bode very well for them. Bank of America, Wells Fargo, Goldman Sachs, Morgan Stanley, and then you've got one of the Mag 7 there on Thursday in Netflix. So it's had an enormous rally. I would be probably surprised if it can maintain that, although there is some positive talk from analysts around it saying that it's that it's now got into a really good groove with its release schedules, and they're not dropping off, subscribers. So key inflation data will come out of the US Tuesday night, Wednesday night. So, and then retail sales will be probably pretty interesting actually in the States on Thursday, because it really is that's followed up by consumer sentiment on the Friday, but the retailer supposedly is suffering quite a bit. Overall, in terms of the Aussie market, we've got employment on Thursday. We had a bit of a surprise in employment, last number, and obviously given we didn't cut rates like everyone was expecting, but the RBA told everyone was happening, that will be a pretty key number, I would have thought, overall as well. So, so we start off with a pretty big week from company-specific levels, and then if you think about it, we're only a couple of weeks away from getting Aussie earnings as well. So we're coming into a pretty busy period. So I think it's very prudent to be staying up to date as much as humanly possible. The Global Alpha Boys will release their podcast today, Bulls versus Bears Global Alpha Edition. Look out for that and subscribe at their pages. Which is on Spotify, YouTube, etc., and obviously on our website as well. But apart from that, have a great day, and we will speak tomorrow. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.